Good evening, everyone. Welcome to today's SAIF Cash Plus launch webinar. We have a guest here with us today, Toche, Senior Fund Manager from Lion Global Investors, as well as Dhruv, CEO and founder of SAIF. And today we have the pleasure of introducing our latest product, which we have launched publicly today, which is SAIF Cash Plus. And without much further ado, I will actually hand over to Dhruv to give us a quick introduction to our product.
Yeah, thanks so much, Sebastian, and thank you for joining us, Toshi. I think this is obviously something that, as you know, we've been working for quite some time now, and it's really exciting that we can finally go live, and we've gone live today. So briefly, just to some of you who are probably don't know much about SAIF, I would like to start off with just a quick history of SAIF, right? I think many of you think that we're relatively new, which some ways I want to believe we are. That keeps us a bit young. But the reality is we've actually been working on SAIF for almost 3.5 years. The journey actually started in September 2017 when we incorporated the company, followed by us getting our CMS license, which was in July 2019. So almost a year and a half in between to build up the team, build up the product, myself, Sebastian, everyone coming together and deciding the right compositions for our users. And thereafter, it's just been launches for us, right? We launched our wealth expertise offerings through our wealth experts in November. We launched the REIT offering, which a lot of you know us for probably, which along with SGX in Feb of last year. And then the Equity 100, which came in July. Now, one significant milestone for us was a very significant Series A raise, which we were very happy to raise in the middle of the pandemic. So we'd raised about $18.6 million, close to about 25 million Sing dollars, which helped us to actually further expand the team and launch new products, which gets us on today, with these esteemed gentlemen on my side, to launch the SAIF Cash Plus, right? And it's actually something that it's a very close topic to our heart and something we'll talk about as we get along. One thing which is very important to know is who are the people, right, which actually get behind SAIF. Now, there's a point where we could have shown you photos on a screen, but we've crossed that point now. We're actually 50+ individuals. If you see, we've probably worked at every significant global as well as local bank, but also at the same time significant consumer institutions, whether it's the conventional ones like P&G or the more new age ones such as the Lazada and Sky Scanners. So a very diversified team, but again, a very deep-rooted financial expertise to build the best products for you. Now, one very key point to know is that, of course, who are we? Are we safe? Are we licensed? So yes, we are actually CMS licensed for retail by the MAS. This actually does ensure a very high level of security of your assets. Your assets are actually custodized through our broker at Citi and as HSBC. So all your US securities, if you take some of our US listed products, they are normally custodized with Citi. Everything else is actually with HSBC. And if I'm correct, even the Lion Fund is actually with HSBC, right?
That's right.
Right. So I think it's something that is very important because we obviously understand safety is very important. Now, when you move money to us, it's also moved to a trust account, which is held with DBS. This is a client-only trust account and completely different from our corporate account. Hence, again, reiterating the fact about trust and safety of your assets. Now, what you might remember us for was what we started off, about close to a year and a half ago, which was the global offering, right? Which was this risk-managed, global product. As a quick recap, this is across equities, bonds, and golds. You basically just choose a risk level and we manage risk for you, right? 11 risk levels. After that, I think the more popular offering, which many of us know for, is the REIT offering, where we actually built a product alongside SGX, which invests in the IEH Leaders Index. The product has done remarkably well, and actually it has even performed very well despite the correction that happened earlier in this year. Here, interestingly, we also offer an option of managing risk by adding on bonds. Now, we're not going to deal into that much today because today is all about Cash Plus. But if you do like to know that, you could join us in one of our subsequent seminars on the topic. Lastly, what we had was the Equity 100, which we launched in June, July of last year. Again, remarkably well, smart beta strategy, 100% equity focus, and a very heavy tech exposure, which also means that it has done extremely well in recent times. And today, we are now launching the Saif Cash Plus. Now, what is Saif Cash Plus all about? Let's get to it, right? So when we really started, right, we thought that, of course, there are these investment options which make a lot of sense, and I think in the long run, that's the right way to do. But one of the problems that we saw was, and this is not just a problem which is in our customers, but I would say across Singapore, across the region. I mean, I remember growing up myself, we were always told to save, 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 put your money in the bank, put your money in the bank, put your money in the bank. That was great when banks were offering good interest rates. That was great when the inflation rates were manageable. That was great in many ways when the real rate of interest was positive. The reality is right now, in majority of economies like Singapore, like Hong Kong, the real rate of interest is actually negative. And if you think that keeping money in your bank account is giving you that extra 5 basis point yield, in reality, actually it's losing value. So $100 is probably closer to $99 after a year rather than 100.5. So we realized this mistake, and we realized that actually, unless we actually start investing out these assets in very safe products, right, people will actually lose and they will destroy their wealth. Now, you might think that what is 1 or 2% in my wealth which is lost? The reality is it might not sound a lot, but over 20 years, 2% will mean your wealth is reduced by half, right? Also, given in our culture, we all have been taught to save and save. If half of our wealth is going to be in a saving bank account, which we don't act on, you are basically destroying it by just leaving it out there. So we looked at what options were available out there, and some of the options, right, is as you can see, right, there are bank accounts which give 5 basis points. There are other products which give anywhere between 25 and 80 basis points. We couldn't cover some other products which give 1.5%. But then what we've seen is many of them, they actually come with certain kind of clauses, like, oh, should you put a minimum amount? Some of them even have deposit amounts which have to be a minimum of $10,000, right? So what we realized was, should we build something where there is no minimum which is given for users? There is no, any kind of thing that should make you feel uncomfortable with the product, but at the same time, give you the optionality to, get high yields. Which gets me to Saif Cash Plus, where we are projecting a yield of up to 1.75%, and how we get there is something we will deal very shortly through this presentation. But before we get into the nitty-gritties of the product, let me tell you about what are the key features which might be relevant for you. Now, first and foremost, the project yield is about 1.75%, and this is as recent as last week. So this is very, very fresh data. This is what we're expecting on the product. The second thing, and a great advantage, is we will accrue your returns on a daily basis. This is something you will see on your app firsthand. You will actually see that $100 become 100.01, or if you're putting $1 million, $1,010,000, right? So depending on how much you're putting in. There is no minimum investment amount. So if you want to try the platform, you can start with as little as you want, or you've got some extra money you want to put it on the side, by all means, go ahead and do it. And there is no limits, right? We've seen some of these accounts which give higher yield. They always say, oh, it's up to 10,000, or it's up to 20,000, and then they change the terms and all. We realize if we genuinely want to have a true cash management product, it can't come with any kind of clauses. And if you see, that's what we've done at every step of the journey. We've removed these kind of clauses. We've given in all the transparency we can. There is no lockup period. Absolutely, you can put the money and take it out tomorrow. There's absolutely nothing on withdrawals as well. There is no cost of withdrawals. Whenever you need the money, it's a single click on the app and you can take the funds out. And lastly, right, you can actually transfer funds, across your portfolios, right? And I think this is a very, very important thing to realize, because what we've realized is a vast majority of our customers are on a recurring kind of a setup, right? Where based on their salaries or their preferences, they do like to dollar cost average. They do like to put, a few $1,000s every month rather than putting a lump sum up front. Now, with the Saif Cash Plus, what you can do is you can place that lump sum in the Cash Plus account, and you will be able to set up a cycle where, you can deposit the money into your portfolios. Now, this feature is coming soon. It should be out in the next, 3 or 4 weeks. But in the meanwhile, you can still put it in the Cash Plus and you can internally transfer it as you normally do. So doing it automatic will come in soon, but currently you can still do it completely on your own. So if you are a person who's doing DCA and if you have the lump sum, but you still want to, put it out in certain pieces, this might be a great option for you. So just in quick summary, a projected yield of 1.75%, daily accrual of returns, comfortable transfer between portfolios, no minimum investment, no limits, no lockup periods, unlimited free withdrawals, right? So essentially, everything that could probably be a concern, is something that we're trying to address out here. Now, the big question, where exactly are we investing? Now, we've actually been working very closely, with the team at Lion, Nicholas, Toche, like everyone, trying to help us to actually see what is the right product. Now, we spend time to realize what has the historical, record of these funds, what has been the drawdown, do they have enough assets under management, do they have enough track record and history? And we've actually come up with a portfolio which we think is great and addresses all these concerns, from a user perspective. So first and foremost, we have the ultra safe money market fund, which approximately will be 30% of your portfolio. Thereafter, we have the enhanced liquidity fund, which will be about 35% of your portfolio. Now, this invests in high quality debt instruments, right? On average, a credit rating of A minus, right? And a weighted average duration, i.e. how often your bonds expire, of 12 months. What that means is somewhere you can also in your mind predict roughly this yield will be somewhat consistent for 12 months. Of course, markets are their only boss, but at least this is good to know that it's something that you can expect not just for the next few days, but something in the foreseeable future. And lastly, and something that I personally quite liked was the short duration bond fund, right? Now, obviously, as the yields have been coming down, going for high quality investment grade options, both in Singaporean as well as international corporates, would be a great option. As you see, it's still only 35% of your portfolio, but the idea is, if you look across the portfolio, it is in many ways balancing the risk and reward, and that's a theme you've probably consistently seen in everything which we've built at Saif, right? With that, I will pass the baton to Toche. Thank you so much.
Thank you very much, Dhruv and Sebastian. We're very happy to be working with Saif on this product. We are equally excited. We think that this product is really very good given the current environment. Now, I'm going to be talking about the short duration bond fund, but before that, maybe a quick background about who we are. So we're from Lion Global Investors, and while maybe some of you might not know about us, but I'm sure you know about our parent company. So we are part of the OCBC group. We are essentially the fund management arm of OCBC. We are we basically manage retail funds and institutional funds, and we've got a long history. We've been managing Asian products for the last 33 years. So owned by headquarters in Singapore, owned by a Singapore company, and obviously we are licensed and regulated by the MAS. So now, the Cash Plus product, as Dhruv has mentioned, there are three components, and here I'm talking about the short duration bond fund component, which is the more risky component, right? Now, the first two products, they are a lot more safer, right? So you don't really have to worry about that. So let's talk about this short duration bond fund. So now, in a very similar reason why Saif came out with this Cash Plus product, which is what do investors do with their money, right? You want to beat the deposit rates that you're getting in a bank. So that's really the same reason why this product was conceived, right? How do we come up with a product that enables investors to earn a better return than what they're getting at the bank, but at the same time, you don't have to worry too much about the risk we're taking, right? So here on the screen, we've been delivering consistent return. If you look at our history, we've been averaging 3% return for our investors. Now, currently we're in a lower interest rate environment, so our yields have fallen. So we're yielding about 2.4%. The average rating of the portfolio is a BBB rated. Now, in bond investments, a BBB is an investment grade, right? If it goes below BBB, that's considered high yield. So the average rating of the portfolio is BBB, and that gives us a very stable credit profile. And because this fund is pretty sizable, it allows us to buy into a lot of different issuers, and this allows us to diversify across many different companies, different industries, right? So in buying over 200 bonds, this allows us to create a diversified portfolio. But having said that, because we are from Singapore, this product was meant for Sing-based investors. So as a result, we focus more on Singapore issuers, right? So the biggest country risk would be from Singapore. Now, while Dhruv has been talking about how we want to generate a higher return, of course, one very key thing we need to look out for is a risk, right? So here we have 3 risks on the screen. So starting from the left-hand side, the currency risk. So in this portfolio, this is a Sing dollar product, so there's no currency risk. All non-Sing investments are all hedged back to Singapore dollars, right? And as a fund manager, I know that currency risks can be very volatile. If I buy a bond that pays me, let's say 3%, right? It takes me 1 year to earn that 3%. But if I were to take a currency risk, I can easily lose that 3% in 1 week, right? Now, this is meant to be a stable product, so I do not want to lose my 3% in 1 week. So as a result, we do not want to have non-Sing dollar exposure in this fund, right? So we fully hedge all the currency risk back to Sing dollar. So it's as if you're buying 100% Sing dollar product. Next is the interest rate risk. Now, as the name implies, this is a short duration bond fund. Now, duration is a measure of the interest rate risk you are taking. Right now, this is a short duration bond fund. The duration of this product is 2 years. Right? The duration of this bond fund is 2 years. Earlier on, Dhruv mentioned that the Cash Plus product will buy into the money market fund and the enhanced liquidity fund. Those 2 funds, the duration would be less than 1 year. Right now, this bond fund, the duration is 2 years. It is still short, right, in the overall scheme of things. Okay, and the way we are investing is basically we buy short-dated bonds, and this is so that if interest rate were to increase, you are cushioned against capital losses if that were to happen. So therefore, we are taking away the interest rate risk in these investments. Now, so I mentioned, we don't take currency risk, we don't take interest rate risk, right? But you need to get return somewhere. So we are taking the credit risk, right? So we're buying to a bond of, let's say, a bond issued by DBS Bank or bond issued by CapitaLand. So we are taking that credit risk. Credit risk means the risk of the issuer not being able to pay you, right? So we do want to take the risk, and that's the risk that we want to retain in this portfolio. And the kind of risk that, or rather the kind of return that you get from taking that kind of credit risk is essentially the accruals. Or to put it another way, it's like earning your coupon, right? So accrual is basically, every day, if nothing happens, you earn that little bit of return. Now, we like that risk, and that's the risk that we want to go for. Now, having said that, credit risk still has to be managed. So we do have certain risk management overlays. So, for example, first of all, we buy into investment-grade bonds, right? That tells you a lot. There's a limit on how much high yield we have. So this is a CPF-approved fund, and under the CPF guidelines, we cannot take more than 5% high yield exposure. We do have our single issuer limit. So for example, we can have more than 3% investment into a certain high yield name, or more than 5% into an investment-grade fund, investment-grade bond. So these are the 3 risks that we think about, and like I said, we want to retain the credit risk. A quick look at the return of our fund. I've said that in the past we've been averaging about 3%. So you can see the past drawdown that we've had. So the most recent March in last year, we had a drawdown of more than 2%. That was during the COVID crisis, right? When you have massive sell-off in the stock market. But having said that, we recovered very quickly, so much so that in the year, we are returning close to 4% for the last year. So we made back the losses very quickly, and we made returns beyond that. So a quick look at what the portfolio has. On the left-hand side, you can see our top 10 holdings. So I mentioned, some of these are household names like CapitaLand. We've got some bank names. You see, like number 5, there's Singapore Technologies. That's 100% Temasek owned. We've got Ascendas, All Green, that's a real estate company. We do have some investment into Singapore government bond funds. So these are, very high quality investment grade names. In the middle, you see our country allocation. As I said, the biggest exposure is to Singapore issuers. The next issuing country will be in China. And China has been a big issuer, and we buy largely the SOE companies, the big and solid companies. So China is also highly rated. China's rating is actually single A at the country level. So a lot of the sovereign link issuers are also rated single A. On the right hand side, you see our sector allocation. So finance and real estate are big sectors. So that's pretty much our portfolio characteristics. On top, you can see our portfolio holdings. We've got more than 200 names. The yield as of now is 2.4%. The duration is 2 years, and the average rating is BBB. So with that, I think that's all I have.
Awesome, thank you.
Thank you.
I think it was interesting, right? Like, I think it's important that users know there are certain risks, but like especially like the currency hedging, that would have acted extremely well, right? Because the Singapore dollar has strengthened a lot.
Yes.
It was almost like 12-13%
Yeah.
if you go back in the last year or so.
I think if you see what happened, especially during this COVID crisis, a lot of people are now, selling dollars because of the potential printing of money by the US Fed, and that has caused investors to lose their confidence in the US dollars. And Singapore has always been a safe haven. And like I said, it's also not during this period. Like we don't want really any currency exposure to this fund. So we just want to hedge out the currency risk.
Yeah. No, that's great. And I mean, and also, despite a very one of its kind event, what happened during COVID, I think the drawdown of about 2.5% is actually still quite manageable given what you had seen in some of the other products across the world. But I also think from our perspective, the fact that this is one of the 3 components, if I look at a portfolio level for Cash Plus, I mean, that drawdown is actually only about 0.7 or 0.8%. We were running the numbers earlier, right? So I think which is very, very positive.
So if you compare that 0.7 against your yield, I mean, your yield can easily cover that.
So you still end up in the positive, right? And like positive, maybe instead of 1.7, you might end up like 1.1 or something, 1.2, right?
That's right.
Right. Yeah. Great. Seb, should we stop for some questions, or should I just quickly go through the rest of the slides?
I think maybe one question, because you just mentioned already part of the answer. One question was exactly about the drawdown, and how does the combination of the 3 different funds, what effect did this have on the drawdown, right? We just saw historically there were some drawdowns, but of course limited. How did the combination of the 3 affect it?
I think maybe I can jump to the last slide now, if that's okay. I mean, I'll just go through the slides because we actually have a slide on this.
Okay, then
which
let's just park the question.
Let's park the question. We'll come back. I think it's a good question. Maybe once we go through it before Q&A, we can just get on with that, right? Great, right? So then obviously the question is like, is there any fees or anything? That's the other plus point. I think some of the other providers recently have been charging. For us, we think that this should be a feature. This is something that you should use before you actually end up, opting for one of our regular, investment portfolios. Hence, there is no management fees by SAIF, and 100% of the trailer fee is actually, returned back to you as rebates, right? If you look at the structure, right, and this is, I think, how did we come up with that 1.75 number? The gross projected return is 1.8%, and this is exactly based on that 30% for money market fund and 35% each for enhanced liquidity and short duration. Then there's a fund level fees across every charges, for all the work that the team at LAN, etc. is doing it's about 35 basis points. But then on the overall rebates, right, we actually end up getting about 30 basis points, right? So effectively, if you, with the no SIFE management fee, as a net user, you have a projected return of 1.75. And this information is also on our website if you're curious to know more about the breakdown and how these things have actually come about. Now, I think one very important question which a lot of people have been asking us since they knew about the cash product is, where does this normally sit into the risk profile? Now, of course, risk is a sensitive topic and it's different for everyone, right? But as we've always said, right, like if you think of an equity 100 product, right, it's obviously high risk, high reward in some ways, right? REIT, is medium to high risk given the fact that there's an element of, physical assets. When you add risk management to it, right, then of course it becomes a bit more medium in that matter. But when you talk about cash, right, given the fact that at least in this product, a very, very large proportion is on treasury or treasury-like, AAA rated products. If you look at SIFE Cash Plus, right, just to give a split, I think roughly about 60% is in sovereign or sovereign-linked products, AAA or fixed deposits, right? And then 40 become the investment grade, as we spoke about. So it's actually a very, very safe product, right? So if you put on the risk scale, it sits right on the left, right? So one of those things, if you just want to take like very, very limited risk with anything, then this is the right kind of option for you, right? And this again, just to summarize, right, like there is no deposit requirement, there is no fees, and you can see how it fades with some of the other kind of competition out there. Now, how do you actually access the product? It's across platform accessibility. You can do it on web or you can do it on the app. It's very simple actually. When you go on, if you download, you finish the KYC, which is required by law. If you have, you can literally start with first and foremost just choosing the portfolio you like. You can start off choosing the portfolio you like, and thereafter you can literally then follow to My Info. And if you do have My Info, the process is just about 3 to 4 minutes. For those of you who are joining us either from overseas or don't have My Info, there's even a manual onboarding, which takes a bit longer, but still, it's less than 10 minutes, right? And again, it's your money, and I think, spending 10 minutes to, find a nice home is not a very long period of time in some ways, right? And thereafter, finally, you can literally, there's a lovely app, you can just see the portfolio out there. If you see the little button on the top which says manage funds, this allows you to easily, move money if you want to withdraw it, move it to a different portfolio, anything that you might want to do, or even want to add funds and top up or create new portfolios. So all very, very simple, yeah. And I think with that, we can get to some Q&A. Should we just start with the first question that you had for me?
Yes, I think that's a very good idea. Maybe we quickly talk about what is the combined drawdown of this.
Sure. Right. So this is actually, if you can see, this individually shows you how each of these, products have basically, performed at different points in time, right? Now, if you combine the three out with the SIFE Cash Plus, the maximum drawdown, which was in this year, was actually 73, basis points, right? Which actually, if you think versus where the product is yielding, you still will end up in the positive. Now, bear in mind, and again, this I'm clarifying because we've seen this normally is a confusion. Drawdown does not mean that that is the money you have lost. Drawdown is the maximum correction you had in the year. If you had held on to it, you would have actually raised and actually gained much more. As the fund, he said, almost gave 4% return last year, right? Net of everything, right? Yep. So basically, if you had done that panic sale because the thing was down, at that instant, you would have lost maybe 70 basis points or 73 basis points in the product. But if you actually held on and as the markets recovered, that drawdown would have never really impacted your portfolio. And which we always say, generally with investing, it's a lot about, the time you have in the markets other than, timing the markets. And 2020 and March was an excellent example of just repeating that once more, right?
Maybe I could add a point about this drawdown, especially in the March episode.
Sure, yeah.
Unlike equity investments, when it comes to bond investment, if I were to have a drawdown in bond investments, the key thing we ask ourselves as a fund manager is, are we still happy with the credit that we are buying, right? So I'll give you an example. I show you my top holding was CapitaLand. In March last year, right, that bond would have fallen during that period, same as any of the bonds that I have in my portfolio. That bond would have dropped, let's say, 2 points, right, during that 1 month. The question I'll be asking myself is, am I still comfortable with the credit? If I'm still happy, I should hold on, right? So unlike equity investment for bond, because my duration is very short, that bond is probably maturing in 2 years' time. As long as I first of all, I'm confident that the company will not default, which we were confident. So then the key thing is just hang on, the bond will recover.
Yeah.
Right.
So if I understand correctly, what you're trying to say is that it's basically a temporary blip, and if you take no action, the bond is anyway supposed to give its 2%, 3% yield.
So the only caveat is your default risk, right?
Default
if you're
risk, right.
confident that the company is not going to default on you, just sit tight.
Which gets addressed by using investment grade or above, typically in some ways and all, right? And that's a very interesting point, right? I mean, so the point is, in an equity market, if you just wait out for time, there's a view it might or might not recover. But in the world of bonds, they have to recover unless, of course, there's a company level default.
The maturity will come, right?
Maturity will come,
The
right?
question is, when does it come? If you're buying short duration bonds, it will come sooner.
Yeah.
Right. So
Agreed, and I think at least for our portfolio, if you look at the average is 1.1 year, right?
Yeah.
So even if there's an event like March again, right? Just
hang on to 1 year.
You'll
just hang on
get
to
the
1
payout,
year.
right? Exactly.
Your money will come back to you.
That's a very good point. Very good point. Yeah.
And I have a question which fits this point, which is, and I'm just quoting, it looks like the issues are very big names and are deemed stable, but the view is surprised that they're only BBB, so triple B rated bonds. So he asked, can you give some names of these triple B rated bonds, and are they safe?
So in my slide, I have my top 10 holdings.
Go back to it, right? Yeah.
I think most of them are triple B names.
Exactly. So I think, would I be correct to say that while triple B might not sound very safe, they are still considered investment grade because we are talking bonds, and even something like an Ascendas or a CapitaLand would be actually rated triple B.
So of these names in this list, only the China Railway is single A. The rest are triple B with the exception of the Singapore government bond. Right?
Yeah.
So the rest of the names
Standard Chartered and CapitaLand, big,
big household names.
Big household names, right? Yeah.
So these are your triple B equivalent of names.
Yeah. But then you have the safer things also, like the SGS, since the Singapore government securities out here. Right.
I think then maybe we go back to something which Dhruv covered quickly already. But the user is again asking, and maybe we can elaborate a little bit about why is SAIF actually launching a product without charging a management fee for it?
Yeah, it's a great thing, right? I mean, the view is that we think that at the end of the day, the Cash Plus basically will be an entry point for the investment portfolios, right? So what we think is, and that's why we talk a lot about the recurring and the investment options, so on and so forth. So our view is that, you come on the cash product because that is where you want to park your funds till you can actually DCA out and, do it. So we think of it like a feature in some ways. But of course, the idea is that if you have that comfort with the cash product and you can build up your recurring cycles of investments, and if we can facilitate that cycle, I think then we've played our role, right? I mean, our role is not to actually promote Cash Plus or REIT Plus or thing. Our promote is to promote the overall financial health of our customers, right? And cash plays a very big role, especially in a culture which is very, very pro saving, right? So the idea was that, we come up with a lot of people who are first time dabbling or, are new. They prefer to start off with something like a Cash Plus and then move to more, the more, I guess, advanced portfolio options, so as to speak.
Perfect, thank you. I think there's one other question which is probably to both of you, which is, and I think it was also already partially covered, but how would interest rate changes affect the portfolio? I think it's a very interesting question. Maybe you want to start?
Sure. I'll take that. Well, as you know, we are in a very low interest rate environment, and even before COVID, we were already in low interest rate environment. With COVID, we've really collapsed in interest rates. The question then is, what will happen to interest rates after, or rather when we recover from COVID, right? Now, in that scenario, in the COVID recovery scenario, obviously you have economies recovering, and typically when economies recover, interest rates tend to go up. Now, having said that, we do know that on the short end of the interest rate or the yield curve, some of these economies, the major economies, are the recovery actually take a while because things we don't go back to normalcy that quickly. And you have seen what the US Fed has said about keeping rates at current level, which is close to zero for easily 2 to 3 years, right? So on the short end of the curve, we do think that will stay true. Now, however, on the long end, meaning 10 years and above, we do see risk of interest rates going up. In fact, just this week, the US 10-year has already gone up by more than 10 basis points over the last 2 days, and this is when you have the blue sweep of the US Senate. And this is because with the control of the Senate, the Biden administration is now able to put on more fiscal stimulus. So when you have the potential of this happening, the market will therefore price a US recovery. Maybe not immediately, but down the road, right? But markets try to price in these things. So therefore, the US interest rate has really gone up by 10 basis points just over the last 2 days. So we are concerned about the long end of the yield curve, or rather the interest rates going up. But having said that, how do you protect yourself from that? And the answer then is don't take too much duration risk, right? So as this product testifies, it's a very safe product. It doesn't take a lot of duration. So this is one way you can protect yourself from interest rates going up. Because if interest rates go up, that's bad for bonds.
Yep. And I think this is the perfect introduction for the next question, which is about can I buy just one out of the three? So can I on the platform pick one out of the three funds? And then there's someone else asking, why don't I put all into just the short duration one, and why do you combine those three, right? And I think this is...
Yeah, so currently on our platform, you can't buy one of the three. I'm sure I'm sure there'll be ways to access it, but maybe at retail pricing and all. See, as I said, our view is to build something that is giving the yield returns, but also matching the risk, right? And our view was that, if you have to individually buy something, then you're probably better off using the other channels available out there, right? The idea is for us to basically combine to make it a very, very safe option. As you can see, how we've looked at a duration of just 1.1 year, a drawdown of just 0.7%, etc. So from our side, it's very important that these aspects are hit when we build our products, right? So if you start cherry picking them out, I think that defeats the purpose of at least us coming in, and then your friendly neighborhood broker might be a better option, right? So
perfect. And maybe this is a question which comes up a couple of times as well. It's about the stability of this 1.75%, which we are saying right now is a projected rate.
Yep.
Do you expect this to change in the short term over the next 1-2 months, or is this something which you think is a more sustainable level?
Yeah, maybe one for you probably.
I think, well, if you look at the market, we are already at this level, and as I said, there's a risk that on the long end side rates could go up. So I guess in the midterm to longer term, rates could go up, and eventually this 0.7 or the number would slowly creep up. In the near future, we think that that number will be stable in the short term to the medium term. Yeah.
Okay, I think
that's sustainable.
Great. Bringing me to one question which is also quite frequently asked, which is about capital guarantees, SDIC insurance, and so on. I don't know who would like to address this.
Yeah, I mean, this is after all an investment product. This is not a bank deposit which is normally covered via SDIC. So there is no SDIC protection per se. But I think what you should remember is where is actually these products going, and many of them are actually going in corporate bonds of banks or grade 1 institutions as such, right? So I feel if they default, then I think we have bigger issues in some ways. But generally, I think it's important to know this is still considered as a very, very low risk investment versus just a saving account. This is not a saving account, and that's also the reason why it's not giving 5 basis points, right? So it's a little bit of risk which comes, but I think for a reward which probably makes sense in some ways.
Yes, and then someone is asking regarding rebalancing. I guess it's a user who's maybe familiar with some
Yeah.
of our other products.
Yeah.
How does rebalancing work for this specific product?
Yeah, so frankly, we don't expect any rebalancing unless there is a significant market event, to be honest, right? Our view, basically, if you looked at back data, was we would not have rebalanced this in the last 5 years at all. The thing is, you might think that you have slightly different yield, but where the yields are, the weightages might vary a little bit. I mean, 30 might become 30.05 or anything, but it's all very minor, right? So that split you see of approximately 30, 35, 35, that will remain the same. And if this changes, we'll know. But my hunch, right, is that any kind of rebalancing probably will not happen for a few years. The idea is to give you some stability in the offering as well, and then we can let the team at Lion do what they do to ensure that these products remain. Because again, if you start rebalancing out, then you start getting into that problem where you might lose on the upside because of the fact these bonds are maturing at some point and so on and so forth. So unless there's a good reason to, we will actually not rebalance, to be honest.
And maybe one more SAIF-related question.
Sure.
Someone is asking regarding our tiering, right? And
Yeah.
we have a tiered pricing for our other products. I mean,
Yeah.
it's not really relevant for this one as we are not charging anything,
Yeah.
but like for other products, does the Cash Plus portfolio contribute to the
Yeah.
tiering?
No, thanks for asking that. Yeah, we should have probably covered that earlier. Yeah. So the Cash Plus actually, as you know, is a zero cost option, right? As in there is no cost. We don't make anything out of Cash Plus. In fact, it's just as a intermediate tool. I think it's a bit unfair if that is used as a tiering tool for people going into black or gold or platinum tiers. So the Cash Plus is actually completely independent of the tiering. So no matter how big or small your contribution is Cash Plus, it will not go towards your tiering of your category.
I think that makes a lot of sense. And then I have a question for Toche, which is two different questions, and I just try to combine them into one. And someone is asking, there is quite a high allocation to China, and then someone else is saying there's zero allocation to the US. And basically, can you elaborate a little bit on this? And China is not a very volatile environment,
Right.
and is there a specific reason why to avoid the US?
So, a few ways of answering this. So, first of all, we are Asian specialists. We invest into Asian equity and bonds. Now, why China? China is a big issuer in the US dollar space. China as a country is rated single A. I know there are lots of headline news about US-China tension and things like that, but we do our credit risk assessment. I did mention every bond that we buy, we have a credit analyst covering that name and putting a credit rating from LGI into that name, and we do our periodic credit checks. And in China, we buy into the big strong entities. So the big four banks, for example, we have a railroad operator from China. So these are the very big institutions in China that's, I know it sounds cliche, but it's really too big to fail. And these are actually very high quality, and they are rated, investment grade. Some of them are single A, some of them are triple B, and these are rated by, your international rating agencies.
And you mentioned the term earlier, like SOE. Right?
Yes, that's right. A lot of them are SOEs because they're too important.
So
they're very
basically
important.
they are sovereign.
They're state-owned.
State-owned enterprises, exactly, right? I think that's the important part. Maybe about the US.
Okay. So if you're talking about credit risk from the US, that we don't find a lot of value in the US. Now we do have investments into the US credits for our other portfolio, but those are benchmark portfolios. In that space, US spreads are very low. In other words, you will not be getting this kind of yield if we were to buy into the US names. So that's the key reason why we're not touching the US names.
And would it be correct to say that basically the yield, considering the risk, is not that high,
Yeah.
and then on top you need to hedge the currency.
right. Okay, well, in the Chinese bonds, for example, they are actually US dollar issuances, right? So it's a US dollar issue by China Railway, for example. We're buying the US dollar tranche, we hedge it back to Singapore dollars. If you have to buy US companies, the credit risk, well, as rated by S&P and Moody's, they are also BBB or single A. So if you were to see it from that point of view, the credit risk is the same, but then you're being paid less. So you're right. So from a risk reward point of view, we don't think that it's suitable for our portfolios.
Great. Thank you for this. Maybe we go to one SAIF related question, like more on the operational side. Someone is asking, like, so how long does it actually take to invest and also like to withdraw in case you want to?
Yeah. So we've actually really had to make the process very, very efficient. If you transfer your funds, before like midday, I would say, we are actually able to invest it out on the same day. Now, as you know, these funds do have a settlement cycle which takes about 2 days. But what is important for you to know is that you've actually got the price of that day itself. And as soon as we get the update from the team at Lion, actually what was the actual price of the product, it starts getting reflected in your portfolio. So I think on the way in, it would take roughly about 2 days should you come in, within like before like 12 p.m. Now on the way out, basically 2 steps have to happen. Firstly, the funds have to first come to us, and then we have to transfer to you. So on the way out, again, I think this process, if it comes and happens, and if you put it in time, it'll take 2 days. But if you come, let's say at 3 p.m. or something, then unfortunately it gets pushed the next day. So it will take its 2 days to then come to us. And thereafter that, we have to transfer to you, which will be an additional day. So I would expect take it between 3 or 4 days. The reason why I'm giving 3 or 4 days is because, again, it depends what time of the day actually both your instruction comes as well as the funds come from Lion to us. If it comes within our processing cycles, we'll process it out. I think the key point, of course, for you to know is that your pricing you will get of the same day if you come before midday or the next day if you come after, for that matter.
Perfect. And then there is one question on the daily accrual.
Yep.
The user is basically asking, what does daily accrual mean? And he's giving an example saying, like, if I withdraw everything after 2 months,
Yeah.
would I really have earned my accruals for these 2 months?
Yeah, it's actually a great point, right? So the way how we have the trailer fee rebates, they actually happen on a quarterly basis. But we've built system and technology on our side to actually show you this on a daily basis, right? So even though a portion of it might be coming to us after 3 months, you will actually get your portion for 2 months. So when you withdraw, what you see is actually what you get, right? So you will get what you have got for those 2 days, and that's something which we do throughout our portfolios. Same thing, in a regular portfolios, when there's a dividend, if you withdraw before the dividend is paid out, we'll actually give it to you. The same thing is done out here, which is actually a very, very good advantage of actually investing with SAIF.
Yeah, and so that it's not only like he doesn't actually need to wait 2 months, but even actually after a week, he will actually have already earned the returns for this period.
Exactly. And plus the rebate, which we will actually give it to the user, even if it comes before the cycle in some regards. Right?
Perfect.
Yeah.
Will there be the referral program which they know from the other portfolios? I think that's actually a question which maybe I can
answer. Yeah, one for you, right?
Answer it.
Yeah.
Yes, so no, I think, of course, we are very happy if you like our product and you tell your friends and family and they come on board. For the same reason as we don't include the cash plus balance into our overall tiering, we also have a slightly reduced referral fee structure. So we pay only a maximum of $10 for a referral of if there's a minimum of a $1,000 deposit. And the funds stay with us for a minimum of 6 months. So yes, do tell your friends and family if you like our product. A question which is also like an an all-time favorite, and you have been asked this before. Where do you park your own funds?
What funds? Yeah. No, so I think, like, obviously, I think for many of us, in the core team of SAIF, myself, Sebastian, all of us, right? I think SAIF is actually our biggest investment in all practical purposes. But within the SAIF portfolios, I generally end up parking a blend across the portfolios for different purposes. So I do invest in the REIT product, and I do have invest in the Equity 100 product for that matter. I think small amounts go in the cash, which is basically unutilized. On my side, it's more about just leaving it there because I don't want to get, like, sometimes, it's quite annoying after a month you get your bank interest, which is like 1 cent or something. So the idea is, like, put a little bit out there, but generally, at least in my view, I am generally very pro investing because from my side, this is the money which I don't immediately need. So I have, like, a very small, I guess, saving in my bank account, which is for emergencies, but which will now be at cash plus, to be honest. Everything else actually goes up, within the portfolios, right? When it comes to the investments, because actually that is what I want to invest in and keep for the very, very long run. So that's what I keep my money up. I'm happy to show it to you. When I have my phone here, I would have shown you the screenshot at some point, right? So yeah.
Good. Thanks. We have covered this as well. Also, this session. There is one question which is a bit about the other two funds of the portfolio, and we have spoken a lot about the short duration bond fund. Yeah. And I think for good reason. Sure. But maybe you can just in a few sentences just outline what are the other two funds basically.
Yeah, sure. That'll be good.
So starting from the safest, which is the Singapore money market fund. So essentially, it buys into very, very liquid cash-like instruments. So we buy into MAS bills. We do take a bit of credit risk, but these are very highly rated. Now, the use of the word money market fund is actually regulated by MAS. So MAS has this certain very strict guidelines. So you can't just call yourself money market fund just like that. You have to park you must keep certain amount in cash and certain amount into, very liquid, highly rated, short-dated products. The next fund, the Enhanced Liquidity Fund, it takes in a little bit more risk, which is why the yield is a bit higher. But nevertheless, the credit quality is still at the single A level, right? So the average rating is A-, and the duration is capped at 12 months. But because we do not label this as a money market fund, we do not have to abide by that, money market fund guidelines under MAS. So this gives us a little bit more flexibility. Credit quality-wise is still very high, right? But it's this little bit of flexibility that allows us to bring up the yield to a bit higher. So that nicely sits between the money market fund and the short duration bond fund.
That's great. Thank you.
Perfect. Thank you. One actually very interesting question. So we have already heard it's maybe not very likely in the short term, but and that's a question definitely for Dhruv. What if the returns would actually increase above this 1.75%? The viewer is literally asking, will you tell us?
Yeah, absolutely. Yeah, I mean, we will actually pass on the whatever returns we get verbatim, right? So let's say 5 years from now, markets are getting better, rates are back up, and this offering is offering, like, let's say, like 4%, right? We will pass as it is, right? Our view is to actually update this information on a quarterly basis at maximum, maybe even lower than that. So maximum every 3 months we want to update this, because at the end of the day, this is your money and you should know where this is going. So we will not take anything away from your returns, if that's your question. Also, on your transaction statement, you can see at the price at which it has bought and what's the value, and this you can publicly verify. So we are very conscious in our ethics to be very transparent about these things.
Great. And there are two questions on something which you also try to cover in every single session, which is a bit about the the safety of funds and how is in general investing maybe with SAIF.
Yeah.
You've mentioned the CMS license and so on, but maybe you can elaborate a little bit what would be a worst case scenario.
Sure, yeah. So I think firstly, like it's important to know that like a CMS license is actually has very, very stringent standards, right? If you compare with let's say an NFA license, a CMS license has much, much higher requirements, right? It's not just base capital, but it's everything like pedigree of the team. It's basically how the company, like we are audited by a big four. There is, external auditors, internal auditors, there's external compliance. We have full-time couple internal compliance and legal personnel. So of course, keeping mechanisms in place to keep the assets safe and secure is very, very important, right? Also, the way how we've structured is that when you do transfer funds, they move to a trust account, which is at DBS, and from there we actually pass it to Lions custodian, which is HSBC, as we had spoken before. So the entire client interaction is completely away from SAIF in some ways, right? It's always and always, in client funds, right? Now, the absolute worst case, what can happen is that if something, happens to SAIF, now it's extremely unlikely because we are extremely well backed and well funded. But because you asked, even in that extreme case, there's actually a very orderly procedure how MAS unwinds and passes these assets out. Because these assets have always been in client account, we technically don't have any claim on them. Conventionally, what will happen is either the regulators will give users an option to withdraw their funds, or they will ask another fund manager to come and take their funds out. So you will not, even the worst case scenario for us, it does not really impact your assets. Now, some people might say, oh, what if the markets are down and I'm forced to sell? The reality is that if markets are down and you're forced to sell, you can buy it back at the same time through another platform, right? So you haven't capitalized any loss, right? So I think it's a big misconception that, what if the markets are down and something happens to us? Extreme case, very unlikely both. But it's important to know that even if that happens, you're actually covered and you're safeguarded. And I'll be happy to talk more. Feel free to reach out to our support or any of our wealth experts to deal more, because this is very, very important to us also that your resources remain safe, because fundamentally this business is all about trust and we are here to stay.
Perfect. Thank you, Dhruv. Toche, a question for you. And the viewer is asking, like, what's actually the difference between buying into one of the Lion funds compared to one of the bond ETFs? Maybe you can just on a high level,
okay,
without going into too much detail, but on a high level, maybe share a little bit the differences.
Okay. So if I were to use my short duration bond fund as example, it really depends on which bond ETF you're comparing, right? In this fund, I've got 200 issuers. The ETF, I mean, in the local context, some of the indices are probably not as well diversified. So, you get better diversification in our fund. Now, this fund, short duration bond fund, the objective is very straightforward. We buy into short-dated, high-quality credit. The ETF that you're buying, you got to think about the credit quality. You got to think about your duration. You got to think about your interest rate risk. Are you diversified enough? So these are things that you have to compare. Again, I do not know which ETF you're referring to. It's very hard for me to make a comparison. But those are the things that you have to. You probably have to do some homework on that ETF and whether or not that index is something suitable for you.
Yeah. Maybe I can just add out here, right? I mean, most of my career has been, was responsible for the ETF desk at UBS, and I'm personally a big believer of ETFs, right? And if you look at many of our products, like Equity 100, they're very ETF based, right? But what we realized was, at least with Singapore dollar, with some of the products that we found, we struggled actually to get the liquidity. And if anyone remembers like what happened to some of the ETFs in Singapore, the Singapore dollar ETFs in March and all, even if the bonds were down like 0.5%, 1%, because the liquidity had dried out, you almost had 8-10% drawdowns on certain occasions, which were actually not really reflective of reality. But if you are forced to sell it out at that price because you're selling out an ETF that is there. So what we realized was this actually was a very big criteria for us also, because honestly, we've always done ETFs, so that is the first time actually when we are doing funds. But we realize for, I wouldn't say, like, I strongly believe for equity in many cases it does not make sense, right? But at least when it comes to some of the fixed income offerings like these ones, I think this is the right way to do it, because then you can manage everything well and transact it, pairing off your buys and sells once a day, rather than just letting external market factors outside of all the factors like duration, currency and interest risk, as you mentioned, right? So something that I think, is also the reason here.
Yeah, so we are basically agnostic to what products we use, right? And we try to use whatever we believe, and our research shows is the best.
Is the best option for it, right?
Exactly.
And this is a great example, because this is the first time we are doing funds, but it just made sense to do it, right? Yeah.
Okay. And there is a great question which I want to bring up here, which is what does it take for the deposit to become zero? And I think it's of course it's a bit of a radical question.
So the
But
value of
the value
to drop to zero.
to zero.
So we're not talking about zero return.
No, I'm not talking about zero return, but the question is really like, what would it take
So the
to
$100 goes to zero.
goes to zero? Yes.
Well,
I think this reaction already shows a lot, but
So-
let's see the
so
answer.
we're talking about the cash plus product, right? And
Yeah.
I think, Dhruv, you earlier mentioned that I think 60% are into Singapore government.
Yeah.
Okay, so
We have bigger problems,
so
basically.
if you think that Singapore government is rated AAA, and if you think that one day Singapore government could be rated, sub-investment grade, then you might lose some money, but it will not be zero still, even if that were to happen. But I mean, I as a Singaporean, I have faith that we will retain our AAA rating for quite a long time. So I don't think that will happen.
So like, in order that the value drops to zero, the Singapore government would actually need to default.
Yes.
Correct?
Go below
Yes.
that, right?
So and which is, I think we all are quite certain that this is very unlikely.
In the world, there are like less than 10 AAA governments.
Yeah.
Singapore is one of them.
And also, like, you don't move from AAA to like
single B.
to like like default grade, right? You might move to single
Move
A,
to
A
single
minus.
A
You
first,
move
yeah.
you move one lower level down, right? So
And then there is, and there's still like questions coming in, and we have a few more minutes to answer as many of them. And Hayden, who is one of our wealth experts, actually is helping us to answer some of them by message. So we really try to answer everyone's questions, but we're also trying to answer as many here, and we have a few more minutes to get through them. There's one question which I found also interesting, which is about the reinvestment, or what happens to the returns actually of this fund. So is there anything which stays actually in cash within the portfolio?
Yeah, so the fund itself actually accrues value, right? So that is what rises. There's a very small portion of rebates which actually comes as cash. But as you might know from our previous portfolios, the day it comes to your account as cash, the next day we'll actually invest it out, right? So in a way, the goal is that you're always and always like 100%. I mean, there might be one day in the middle where you're not, but otherwise every day you're 100% invested out. And that's again the power of compounding, and which is something that we've built, and we use it across our portfolios. As you might have like the reinvesting of dividends in REITs, the same thing will happen here as well.
Great. And then there's a lot of questions which I try to combine a little bit, which is about allocation. And they range from, how much should I put into the different SIFE investment portfolios compared to Cash Plus, or how much of my overall wealth should I park into such a solution. I think there's no general answer to that.
Yeah.
But maybe you can give a little bit of guidance on how you look at this.
Yeah, I mean, it's a great question, but it's actually very, very subjective to everyone, right? I think typically we focus a lot on what you really want to achieve from your financial objectives, right? So if your goal is, let's say you want some sort of a stable passive income kind of a stream, you prefer something like REITs. If you want a very stable option with a very strong, guarantee and, very, very low risk, you go for something like Cash Plus. If you want something which is essentially for a high risk, high reward, you go for Equity 100, right? So I think that it'll be very tough, just on the basis of this to say, where, how much you should put in. I think one thing that I would strongly recommend is you can speak to our wealth experts to better understand our products, but I think eventually this choice has to be still yours. And we can't tell you that, do this and do that, but our goal is to make you understand what these different options are and what are the pros and cons of each option, right? Now, in my personal case, I generally am a believer of the fact that in the long run, like, the value of money will reduce, and that's why you have to do something with it. So I say that I'm still at the stage in my life where I can be more, I would say, a bit more on the risk-taking side. That's why, as I mentioned earlier, my portfolio is still skewed more towards equity 100 and to REITs. But as, of course, as I get older and as, I reach into my, my late 50s and 60s and all, I would preferably want a lower risk kind of a thing. And there are some mechanisms actually out there which we can probably, direct you towards once you reach out. This kind of a glide path mechanism which can actually help you, realize, okay, let's say if you retire at 65, you're going to live till the age of 90. What is the kind of money you need? How do you look back at it and set goals based on that, right? So it's a very person-to-person thing, but generally when you are earlier in your life, the presumption is that you can take a higher risk because A, you have a stable source of income in your salary. B, of course, you have time, which probably is one of the best weapons you can have when it comes to investing.
Great. I see a couple of questions which come up again and again as we go through this. We are actually uploading this webinar to YouTube in the next couple of days. So if you have the feeling that your question wasn't answered, please check our YouTube channel, and I think we have a lot of these questions actually covered in the past. I think maybe one or maximum two last questions before we wrap up. Maybe like this, we did have it in the very beginning to a certain extent, but how simple is it to switch between the different portfolios and the Cash Plus? Does it also take the 3 days which you have mentioned for the withdrawal, or is it a similar timing? And are there any fees when you switch between portfolios?
Yeah, so there's a little button on top of your app or website which says Manage Funds. It's actually just like a couple of clicks, right? Very, very quick. All you give is the amount, choose the portfolio you want to transfer to, and it's done. It's very, very quick. The duration is similar because at the end of the day, we still have to, sell one and buy the other, right? Across all our portfolios, when we say free unlimited withdrawals, that's what we really mean. It's basically absolutely free, whether as you move to any portfolios and move back. I would advise that don't really do it because if you're doing that, you end up becoming more of a trader than an investor. Most of my career I've been a trader, and trust me, it's unless you're doing it day in, day out, I don't think that's worth it. I think our platform is more geared to those who are investing. We've actually, and we should probably publish this out, we were running some numbers. We realized the people who performed best on our products were those who tinkered the least, rather than trying to, oh, should I withdraw some here, should I place some here? This is a long-term game. This is investing. This is not trading. So I would say that please keep that in mind. But again, to your point, you can do it for free and do it as many times as you want.
Great, and I think this was a great last answer for today. Thank you very much for joining us today.
Thank you very much. Thank you so much.
It was very insightful, and thanks Dhruv again for also joining us today. Really a great session tonight. It's quite late, so as I already mentioned, the recording of this will be available also at a later point through YouTube. And for today, again, thank you very much, and
thank you.
Have a great evening.
Thank you so much, Sebastian.
Thank you.
Thanks.